Welcome to the Deep Dive, where we unpack the latest info, focusing on what really matters for you. Today, we're diving headfirst into Donegal Group's Q2 2025 earnings call. And this wasn't just, another standard quarter. It really signals the company in a pretty significant strategic transition, making some tough choices now, hoping for, bigger rewards down the line. We're going to break down the numbers, get into the management view, and look at the forces shaping their future. Our mission: give you the key takeaways so you walk away really understanding what's going on.
Yeah, it's a really interesting one. It's a great look at how an insurer tries to navigate, a pretty complex and often volatile market. Donegal's Q2 results, they really show this calculated trade-off. They're sort of sacrificing that immediate top-line growth. Why? To build a much stronger, more profitable foundation. The numbers, they really tell that story of strategic discipline.
Absolutely. So, let's jump right into those results. On the surface, Donegal Group delivered what, a lot of people called a mixed bag. And it definitely sparked questions from the market. The good news for the bottom line, they actually beat earnings expectations. Non-GAAP operating EPS came in at $0.43. It's a $1.04 beat against the $1.39 consensus.
Yeah.
And GAAP EPS was $0.46, so a strong profitability there.
Definitely strong on the bottom line. But like you said, a mixed bag. Because the top line, that told a different story. Total revenue was $247.1 million. That missed the consensus estimate of $253.5 million by about 2.5%, even though technically it was up a tiny bit, 0.2%. Year over year. This revenue miss, and I think crucially that noticeable decline in net premiums written, that really caught the market's eye immediately.
That's right. Net premiums written, NPW, basically the total premiums on policies they sold or renewed in the quarter, that decreased by 5.4% year over year. Came in at $233.8 million. And net premiums earned, that saw a slight decrease too, about 1.1%. Okay, but here's where it gets really interesting. And why mixed bag is like the perfect description. Their combined ratio, that's the critical measure of underwriting profitability for insurers. It improved dramatically, came in at 97.7%. That is a huge 530 basis point reduction compared to last year. Just a reminder, a basis point is 0.01%. So 530 points lower means they're keeping much more of each premium dollar after paying claims and expenses, much more profitable underwriting.
And that, for me, that's the absolute key takeaway from just this snapshot of the results. These numbers, they seem contradictory, right? Lower revenue, but much, much stronger underwriting profit. But that's precisely the point. It highlights management's deliberate strategy. They are explicitly trading that short-term top-line growth for dramatically better underwriting results. It's a calculated, long-game pivot. We also saw, pretty robust net investment income. That grew 13.3% year over year to $12.5 million. And book value per share increased too, up to $16.62. That's up $2.14 from last year. These are, strong signs. Shows how well they're generating capital and managing their investments on the side.
Okay, so one hand, you've got this clear signal of financial health, improved core operations. But on the other hand, that revenue miss gave investors some pause. It really sets up the central tension here. All right, let's peel back another layer. Let's dig deeper into what's driving these numbers, starting with that impressive underwriting discipline.
Yeah, let's connect this to the bigger picture. That underwriting discipline, it's absolutely the core pillar of their whole strategy right now. The core loss ratio, that's basically losses paid out divided by premiums earned before other expenses that decrease significantly by 5 percentage points year over year. And what's really striking, a remarkable 12 percentage point decrease just in personal lines was the main driver. That tells you their efforts, their push to improve the quality and profitability of their personal lines business, it's working. It's yielding real substantial results.
Wow, 12 points in personal lines. That's a massive shift, especially in a segment that can be notoriously tough for profitability.
Yeah.
But it wasn't all smooth sailing, right? The call mentioned elevated weather losses. They contributed 11.1% to the loss ratio. That's actually above their 5-year average of 9.2%. Homeowners get hit particularly hard. Weather represented like 36.4 points of its loss ratio. Almost like an annual stress test from Mother Nature, isn't it?
Oh.
So how are they trying to build a stronger financial roof against that kind of volatility?
That's a great question. And they are definitely being proactive about it. Management talked about implementing larger deductibles, specifically for wind and hail, and also limiting roof coverage for older roofs when they convert personal lines policies onto their new system. These are direct responses. They're trying to combat both, the increasing frequency and severity of weather events and the rising costs of repairs. It's really about risk mitigation, even if it means tweaking their coverage or pricing a bit.
Okay, makes sense. And on the flip side of those losses, they did get some help from favorable prior year development, about $3 million net favorable development. That's from reserves set aside in previous years proving to be a bit too high. That gave them a 1.3 percentage point reduction to the loss ratio this quarter, mostly from personal auto, homeowners, workers' comp, and commercial multi-peril. Always a welcome boost, right? Shows good reserving practices in the past.
Absolutely. Now, their personal line strategy specifically, you can see it's very deliberate, almost like a surgical strike for profitability. That 15.3% year-over-year decrease in personal lines NPW, that wasn't an accident. It wasn't market forces alone. It was a direct result of planned attrition, targeted non-renewals. They specifically mention exiting a legacy Maryland book of business and a deliberate slowdown in writing new personal lines policies. Now, the good news, maybe for you listening, is management said controls on new business are now being strategically relaxed. What that suggests is they feel they've achieved what they call rate adequacy, basically, getting the prices right across their footprint. It signals they might be ready to start growing again, but this time, on their own terms, profitably.
Okay, so they've been intentionally shrinking, shedding business they deemed unprofitable, taking that short-term hit on the top line. But now they feel they've got the pricing right to maybe start growing again, but more carefully. That's a strong pivot. How does this compare to commercial lines? Are we seeing the same kind of top-line sacrifice there, or is that a different story?
Commercial lines is, bit of a different story. Commercial NPW actually saw a modest increase, up 1.9% year over year. This reflects a more targeted approach. They're aiming for selective growth, focusing on highly profitable classes of business. They're maintaining really strict underwriting and pricing discipline, even in a market that's showing some signs of softening for new business. It really shows their commitment, sticking to profitability over just sheer volume.
And it looks like that discipline is showing up in the rates they're actually getting. The average rate increases were pretty impressive, 7.8% overall, and even higher, 8.7% if you exclude workers' comp. We saw commercial multi-peril renewal rates jump 11.7%, commercial auto up 10.9%, commercial umbrella 10.1%. Big numbers. Personal lines saw decent increases too, homeowners up 8.1%, personal auto 4.5%. That kind of rate achievement, that really underpins the underwriting improvements, doesn't it? It gives them more buffer against claims.
It certainly does. And something else that's really fascinating here is the progress they're making on their big systems modernization project. This has been a huge undertaking for them. Basically rebuilding their entire operational backbone. They hit a major milestone this quarter, deploying the final major commercial line systems release. And they're continuing to convert the old legacy personal lines policies, homeowners, auto, umbrella, onto the new platform. Those conversions are planned for later this year.
Okay, so this systems overhaul, it sounds like it promises future gains, but it's probably been a real cost headwind in the meantime. Can you talk about that cost impact and maybe when we might see it ease up?
Absolutely. Yeah, it has been a drag on expenses. This project added about 1.2 percentage point to the 2025 expense ratio, which is actually down a bit from about 1.3 points in 2024. So, progress. But the crucial part is these costs are expected to subside gradually over the next several years. This promises not just future operational efficiencies, things running smoother, cheaper, but also potentially deeper, more valuable underwriting insights from the new data capabilities, which should ultimately support their long-term profit goals. It's a foundational investment, really.
Right, a long-term play, but important for future efficiency. And speaking of expense management overall, the Q2 expense ratio was 32.2%. That was a small increase from 31.9% last year. They said it was mainly due to higher underwriting-based incentive costs, like bonuses tied to good results. But importantly, management also said their overall expense reduction initiatives are on track. They expect to reduce the expense ratio by 2 full points from their original 2024 business plan projection by the end of 2025. So that shows they're not just waiting for the new systems, they're actively managing costs right now.
That's right. Active management is definitely key there. Now, beyond the underwriting, which is, the core insurance business, there's another powerful engine for Donegal's profitability. It's found in a maybe less obvious place, their strategic investment portfolio. That also delivered strong results this quarter. Net investment income was robust, up 13.3% year over year to $12.5 million. And the average tax equivalent yield on their portfolio increased to 3.64%.
Yeah, this is where their proactive management of assets really seems to be paying off. They strategically shifted some money away from lower yielding U.S. Treasury and agency debt, moved it into things like non-agency structured notes and tax-exempt municipal bonds, higher yields potentially. And even more impactful, look at their cash flow reinvestment. Cash that was only yielding 3.34% was reinvested at a much higher 5.67%. They project that alone will boost annual investment income by $2 million. That's significant. And that bond restructuring sounds incredibly savvy too, swapping low yield for high yield bonds. But are there any potential downsides or hidden risks with these kinds of shifts, moving into non-agency notes municipals, even if the income is higher?
That's a really astute question because, well, all investment comes with risk, right? In this case, yes, they were aiming for higher yields, but they also emphasized they were trying to improve credit quality where possible and also extending the duration, the length of time until the bonds mature to lock in these attractive rates for longer. Now, the shift to non-agency structured notes and some municipal bonds, yes, while generally higher yielding, it does require careful due diligence. It implies a slightly different risk profile than just plain government debt, definitely. However, their stated goal included improving credit quality and extending duration. That suggests it was a well-considered trade-off, not just chasing yield blindly. They're projecting about $135 million in cash flow from the portfolio over the next 12 months, which they can continue to reinvest, presumably at these higher current rates. It shows, I think, an opportunistic and thoughtful approach to using their capital in this interest rate environment.
Okay, that makes sense. It's a powerful lever for generating income alongside the underwriting. So let's put this all together now. What does it mean in the broader investor context? What are the macro trends they're dealing with?
Well, the overall U.S. property and casualty pricing environment, it's still rising, but the pace is definitely moderating. We saw an average increase of about 3.7% in Q2. But interestingly, global composite rates are actually seeing a decrease now. It indicates maybe an easing, but still generally firm market, not the crazy hard market of a year or two ago. This environment, well, it makes their focus on that internal underwriting discipline even more critical. They can't just rely on broad market price hikes lifting all boats anymore.
Right. And they're also keeping a very close eye on social inflation. That's a growing concern across the whole insurance industry. We're talking about trends like heavy attorney advertising pushing claims, aggressive jury anchoring tactics, the rise of third-party litigation financing companies investing in lawsuits for profit, and those notorious nuclear verdicts. Jury awards that just seem way out of line with typical damages. These factors, they significantly drive up the cost, especially for general liability and umbrella claims, makes losses much harder to predict and manage.
Exactly. And then on the medical side, you've got medical utilization rates increasing. People are using more healthcare services. That puts pressure on bodily injury claim costs. Although there is a small silver lining they mentioned, workers' compensation medical costs have remained relatively stable. So that helps a bit in that specific segment. But these are all external forces, right? Every insurer faces them, which makes Donegal's internal discipline, that focus on what they can control, even more noteworthy.
Okay, so given all these complexities, these headwinds, CEO Kevin Burke actually expressed satisfaction with the Q2 results. He emphasized the strength of their strategic execution, that underwriting discipline, especially getting that loss ratio down despite the bad weather. And the overall sentiment from market research reports seems to be sort of constructively bullish. Analysts see the clear underwriting improvement and the higher investment income as strong positives, sort of offsetting that top-line softness for now.
However, the immediate market reaction on the day was certainly more cautious. While management was busy highlighting the long-term strategic benefits, improved profitability, future efficiency, investors, at least initially, seemed to focus pretty heavily on that revenue miss and the decline in net premiums written. The stock did take a noticeable dip on the announcement day. It reflects that immediate concern over growth metrics.
Right, the classic tension between short-term numbers and long-term strategy. So looking ahead, management didn't give specific number guidance for the full year, but they do expect those systems modernization costs to keep coming down gradually. And crucially, they expect personal lines premium production to make meaningful progress by the end of 2025. That's as they start to relax those new business controls we talked about.
Yeah. And their ambition, their long-term target remains a mid-90s combined ratio through the cycle, which is, a strong target for consistent profitability. Key things to watch, catalysts for future performance, definitely how they manage loss ratio seasonality, especially the upcoming hurricane and fall storm season. That's always a big one. Also seeing clear evidence that those expense headwinds from the system modernization are actually abating on schedule. We'll also be watching the pace of that personal lines pruning. Are they done shrinking? And any future capital actions like buybacks or special dividends beyond just the regular dividend. Conversely, what could hurt them? Obviously, a really severe weather quarter. Or if commercial pricing suddenly softens much faster than expected, those could definitely pressure results.
Okay, great summary. Now let's shift gears for a moment. Time for our not financial advice segment. Let's turn this into a bit of a thought experiment. Given everything we just discussed about Donegal's Q2, if I were pitching an outrageous but plausible trade idea, it would probably revolve around a kind of barbell strategy, basically playing their long-term strategic pivot against that unpredictable short-term weather volatility.
Interesting. A barbell. Okay. What's the core tension you're trying to exploit there?
Well, it's essentially about betting on their long-term improvements, while tactically hedging against that ever-present unpredictable weather risk that hits insurers. So the idea would be maybe something like this. Go long Donegal Group, perhaps through a structured product, something designed to benefit specifically from that sustained underwriting profitability and the rising investment income we see. This captures the underlying fundamental improvement, the efficiency gains coming from the system's modernization eventually. But simultaneously, you might buy some short-dated, out-of-the-money put options, essentially a tactical short-term bet against the stock. And you'd time this specifically for, say, late Q3, early Q4, right when hurricane season and fall convective storms are most likely. The goal is to hedge against one of those big weather events that we know can disproportionately whack insurance stocks, even if the underlying business is improving.
Huh. That's actually a pretty sophisticated way to think about managing the known, but ultimately unquantifiable risks in this sector. It really highlights how investors often have to balance that strategic long game against these immediate, high-impact, random events. Exactly. Donegal is demonstrably improving its core underwriting. Investment income is strong. Those are powerful long-term drivers. The personal lines pruning, the systems upgrade, they're setting the stage for a more efficient, more profitable company down the road. However, the stock has shown it's sensitive to weather news, and weather is elevated, it's unpredictable. That creates these short-term pricing dislocations, these dips. So this strategy, in theory, lets you capture that underlying fundamental improvement while mitigating the known risk of a weather-heavy quarter that could knock the shares down temporarily. It might even create a better re-entry point for the long position if a weather event does hit the stock price.
Yeah, it really emphasizes that dual nature of an insurer's business, doesn't it? There's this steady long-term capital allocation side, and then there's the immediate, unpredictable risk management side. So wrapping up, what does this all mean for you, our listener? Donegal Group's Q2 2025 results, they really paint a picture of a company intentionally sacrificing some top-line growth right now. Why? To build a more disciplined, more profitable core business, it's very much a strategic long game. They're heavily invested in modernization, in underwriting rigor, and they're aiming for compounding returns down the line.
And this quarter perfectly highlights that critical balance, that tension between immediate market perception, which often just latches onto top-line figures, and the actual long-term value creation that comes from smart strategic execution in a really complex industry like insurance. It's about understanding which metrics truly drive sustainable value over time, not just quarter-to-quarter noise.
And remember, as always, this deep dive is for informational purposes only. It is definitely not financial advice. We strongly encourage you to do your own research and due diligence. As you consider Donegal Group's path forward, here's a provocative thought to leave you with. How quickly, and maybe how fully, will the market begin to truly recognize and reward the long-term compounding power of sustained underwriting profitability over just focusing on short-term premium volume, especially in an industry that's facing such persistent external pressures like weather and social inflation?
That's the million-dollar question for investors in this space, isn't it?
It really is. We'll be here to keep dissecting these calls, trying to give you the clarity you need. Until next time.